$1.2 trillion is now tied to AI-related investment-grade debt, the largest slice of the market. That number does not describe a single company or a single loan. It describes a funding system stretching across hyperscalers, banks, and bond investors, all trying to finance a global $2.7 trillion data center build-out. The scale matters because this is not normal corporate borrowing. It is a long-duration wager that today's AI infrastructure will remain valuable long after the chips inside it are obsolete. Big tech is not just spending on servers and power. It is building a credit structure around the assumption that demand keeps compounding fast enough to justify the debt. By late 2024, capital expenditures begin accelerating. By 2025, AI investment spreads deeper into public and private debt markets, pulling more of the credit system into the same orbit. The result is a market where AI-related bonds start to define what looks safe, what looks risky, and who gets funded cheaply. Then, in March 2026, Apollo Global Management caps redemptions on its $25 billion debt solutions fund amid AI disruption fears. That move signals something important. Investors are no longer treating AI as a theme. They are treating it as a force that can reprice entire credit portfolios. This is the beginning of a debt supercycle, and the first question is simple. How did this massive wave of borrowing begin? The shift starts with scarcity. In late 2024, AI-driven capital expenditure accelerates, and the biggest spenders move first. Microsoft and Amazon increase capital spending as if the constraint is no longer speed, but meeting a demand that has completely outstripped supply. That matters because the early story around AI infrastructure is not caution. It is conviction. The market treats data centers, power, and chip supply as the backbone of a next-generation general-purpose technology, one that can justify durable returns over many years. What changes next is not the existence of demand, it is the shape of financing. As more money chases AI buildouts, the market stops asking whether funding is available and starts asking which credits deserve it. Scarcity gives way to selection. In that environment, AI-linked debt begins to stand apart. Borrowers tied to hyperscale expansion look stronger. Their CapEx is not read as waste, but as evidence of strategic necessity. Credit starts to follow the companies that can keep building at scale. The result is a new hierarchy inside investment-grade debt. AI exposure becomes a signal of access, resilience, and perceived future earning power. The bond market is no longer pricing every large issuer the same way. It is separating the AI-adapted from everyone else. That is the hidden turn in 2024 and 2025. Not just more borrowing, but a selective market built around belief in AI's long runway. And once selection takes hold, the next question is whether the first signs of payoff are real enough to keep the cycle moving. By 2025, the hype is no longer confined to earnings calls or keynote stages. It moves into public and private debt markets, where long-duration AI-related bond issuance grows, and capital starts chasing the same future from both sides of the balance sheet. Wall Street notices immediately. Investment banking fees rise double digits, then approach 50% year over year, as banks underwrite AI infrastructure, semiconductor expansion, and even the orbital economy. The fee pool expands because the market is not merely funding growth. It is funding conviction. That conviction becomes visible in the spending plans. Amazon, Microsoft, Alphabet, Meta, and Oracle together point toward roughly $660 billion to $750 billion of CapEx in 2026. Those numbers do not just signal ambition. They create the borrowing need that turns a hype cycle into a debt market event. In the first quarter of 2026 alone, more than $100 billion in new tech-related debt comes to market. Alphabet sells a $32 billion bond. Oracle adds an $18 billion data center tranche. Each deal reinforces the same message. The biggest players are confident enough to finance the next phase at scale, and lenders are still willing to meet them there. What looks like momentum is also leverage. The boom is now broad enough to support itself, but broad enough to spread its risk. The next question is whether this confidence hides a fragility the market is not pricing correctly. The blind spot is time. Leading-edge AI chips are expected to stay useful for roughly 5 years, but the debt used to buy them stretches far longer. That mismatch is not a footnote. It is the structural weakness at the center of the AI credit boom. A 5-year asset financed with decades-long obligations only works if rapid upgrades, rising cash flow, and cheap refinancing remain intact. If any one of those assumptions weakens, the balance sheet does not simply bend, it begins to strain. That strain is visible in March 2026, when Apollo Global Management caps redemptions on its $25 billion Apollo Debt Solutions Fund. The move signals a market rotation, not just a liquidity event. Investors are shifting away from legacy SaaS and toward companies that look AI-enabled, creditworthy, and adaptable enough to survive the new standard. The consequence is selective financing. Legacy software firms and other non-AI adapted companies face tighter lending terms, while enterprise values erode as lenders demand more proof of resilience. Credit is no longer priced only on size or history. It is priced on whether a company can keep pace with AI infrastructure economics. That is the hidden shock. The AI build-out does not just create winners at the top. It redraws the lending map beneath them, exposing businesses that cannot keep up. The market is not merely funding intelligence, it is punishing lag. Next come the concrete consequences for markets and companies. The mismatch now reaches the bond market itself. Hyperscalers such as Amazon, Alphabet, Meta, and Oracle start to look like the new safe havens for credit investors, not because they are risk-free, but because they can keep funding AI infrastructure at scale. In a market shifting from scarcity to selection, that matters more than old labels ever did. The repricing is uneven. Borrowers without a clear AI adjustment face tighter spreads, stricter terms, and less forgiving lenders. Legacy software firms, especially those with weaker narratives around AI adaptation, see enterprise values erode as capital moves toward credits tied to the build-out. The gap is no longer theoretical. It is written into financing conditions. The deeper risk is duration. If chip obsolescence arrives faster than repayment schedules, the debt does not disappear. It sits on balance sheets as stranded capital, a claim on future cash flows that may never fully materialize. That is the overhang investors are starting to price in. Not just whether AI works, but whether the financing outlasts the hardware. Apollo's $25 billion Debt Solutions Fund redemption cap in March 2026 becomes an early signal of that stress. So do rotating allocations away from legacy SaaS and toward AI-linked names. Credit is not frozen, but it is sorting sharply, and the sorting process is exposing who can survive the new cycle. That leaves a harder question. What framework helps investors avoid repeating this blind spot? A hidden fragility sits inside the AI debt boom. The asset can age out in about 5 years, while the financing can run for decades, even centuries. That mismatch is the strategic blind spot. It looks efficient in the moment because hyperscalers keep raising capital, and the $2.7 trillion data center build-out keeps expanding. But the credit structure only works if the technology outlives the liabilities attached to it. By 2025, Long-duration AI-related bonds are already pulling more of the market into the same wager. The result is $1.2 trillion of AI-related investment-grade debt concentrated around the firms most able to absorb scale. That concentration creates confidence, but it also creates dependence on a narrow group of issuers. Then the market starts selecting. Apollo's $25 billion fund redemption cap in March 2026 shows investors rotating, not broadly retreating. Hyperscalers look like safe havens. Legacy firms face tighter terms. Credit quality is no longer about size alone. It is about whether a business can keep pace with an asset base that may need replacement long before the debt matures. The lesson is simple but hard to apply. Align debt horizons with useful life, stress test refinancing assumptions, and avoid treating one technology cycle as a permanent credit anchor. When financing lasts longer than the hardware, who is really carrying the risk?